Hello, I'm Stephanie Hackett, partner and portfolio manager at Evercore Wealth Management. Today, I will share how we think about private equity, an asset class that is increasingly important for investors seeking long-term growth and diversification. Private equity is an attractive and important asset class for most ultra-high net worth investors, and for good reason. As we see here, private equity has historically outperformed public markets over multiple time horizons. This advantage reflects its more hands-on, longer-term ownership model, one that enables managers to help businesses expand, restructure, and strengthen through different market environments. At the same time, private equity firms purchase their interests at valuations lower than those in the public markets. The private equity landscape has also evolved. As illustrated here, the number of private equity-backed companies in the U.S. is now outnumbers public companies by 2.5 times, a 400% increase since 2000. And many of those private companies are now looking for new capital to scale up and expand into new markets, making now an opportune time to have capital to invest. This is a growing, dynamic ecosystem, and we want our clients to have the best possible access to it. So how do we do that? We allocate across diversified sectors, investment vintage years, and strategies to complement our broader asset allocation and optimize for our clients' needs. I'll highlight 2 areas of particular interest within private equity. The first is private equity buyouts. These are investments in established businesses with stable cash flows. Managers typically pursue operational improvements, geographic or product expansion, cost rationalization, or bolt-on acquisitions. Buyouts often involve majority ownership stakes and use more leverage. The second is growth equity. These are investments in fast-growing companies with proven models, recurring revenue, and high customer retention. Growth equity generally involves minority ownership stakes with limited or no debt. And within these 2 strategies, we're targeting specific kinds of opportunities. Industries with either compelling valuations, secular growth trends, or strong potential for operational improvement. These can include high growth and in-demand sectors such as tech-enabled business services, healthcare, and essential services. In addition to being scalable businesses with efficient cost structures, these areas tend to have less direct exposure to international trade and tariffs. Within buyouts, we are emphasizing funds that are targeting small and middle market companies, where valuations are attractive and operational value creation is most impactful. Another advantage to small and mid-market companies is that there are multiple paths to exit. Many of these companies are ultimately acquired up the food chain, often at higher multiples, through exits to larger private equity firms or corporates, secondary sales, or even IPOs. This is still an inefficient market, meaning that manager skill is critical. The performance gap between top quartile and bottom quartile managers can exceed 20%. Top performers buy well, build well, and sell well, creating real value, capturing higher multiples at exit. Also, top-performing managers often remain top performers for decades. At Evercore Wealth Management, we focus on identifying and partnering with those top managers, the ones with the discipline, access, and expertise to generate attractive returns for our clients. Private equity can be an important component of a long-term portfolio, adding diversification and potential for outsized growth. Private equity and other illiquid investments generally represent between 5 to 20% of individual portfolios, depending on liquidity needs, investment time horizon, and each client's goals. Please contact us if you would like to learn more. We look forward to hearing from you.